In this video, I'll analyze the Q1 FY26 result and Concall of 4 flexible workspace companies. One is Awfis, one is EFC, one is Indiqube spaces, and then Dev Accelerators. Okay, so if I talk about this industry of flexible workspace, it is a relatively very new concept, very new industry. So at first, let's understand the business model. So let's say a company wants to develop a new workspace or new office for them. So what they generally do is they take a building or a space on rent, then they do all the capex in that space, like furniture work, like interior work. Okay, but the problem with this model is that they have to spend lots of money upfront on capex, and then if they want to close that building, if they want to close that office, or even if they want to move that office from that location to another location, then the whole capex, whole investment becomes zero. So here comes the concept of flexible workspace, where a company like EFC or Awfis takes a space, okay, takes a space or building on rent, then they do all the capex in that space, and then they rent that building or rent that space out to different companies. Okay, so it is a very good model, and if I talk about it, it is a very it is a win-win situation for both the companies, for the flexible workspace company and the company who are taking that spaces on rent. Okay, so both for both of them it is a win-win situation. Why? If I talk about from the perspective of the flexible workspace companies like EFC and Awfis, then what they are getting a rent to revenue of 2 to 2.5x. Rent to revenue means, let's say if a company is paying 10 rupees of rent to the landlord, then they are generating 20 to 25 rupees of revenue from that space or that building. So the yield is high. Okay, yield is higher than the normal. So that is the thing for the flexible workspace companies like EFC and Awfis. And if I talk about from the perspective of the companies who are taking those spaces, then the benefit is they do not have to spend lots of money upfront in terms of the capex. Okay, so that is the first benefit they are getting, that they don't have to spend lots of money upfront. And number second is, if they want to move that office to that location to another location, they can do it easily. Obviously there is some kind of a locking period of 3-4 years, but after that they can move from that location to another location without any problem. Okay, that is the second point. Okay, and these are the main two points there. So that is why this model is a win-win model for both the co-working space, the flexible workspace company, and the company who are taking these spaces. So that is the thing, and that is the business model of all of these companies. Okay, and if I go little deep into the strategies that the companies are following, there are two strategies that companies follow on both procurement and the rent side. On the procurement side, if I talk about the two strategies they are following, is that one is straight lease. Okay, in this strategy, what the companies are doing, like a company like EFC or Awfis taking a space on rent straight. Okay, like they are paying 8% something 5% to the landlord, and they are developing that whole space, and then they sell that space to another company. Okay, then they rent that space out to another company. So this is the straight lease model. And one another model is managed aggregation, where the companies like EFC and Awfis do a agreement with the landlord that the landlord have to do all the capex. Okay, the capex is done by the landlord in this model, and then in terms of the revenue there will be a revenue sharing model. Okay, like X amount will be for landlord, will go to the landlord, and Y amount will go to the company like EFC or Awfis. So that is the thing here. In terms of the procurement, these are the two models mainly the company follows. So that is the thing. And if I talk about the managed aggregation, it is also a win-win deal for both the landlord and the company. Why? Because the landlord can earn more money. I mean, if their space do well in the future, obviously they can earn more than the normal. Okay, that is what the landlord will get. And what the company will get, the company, because all the capex are done by the landlord, the company don't have to spend too much of money. So obviously as it is a asset light business, the company can expand faster. Okay, so that is what the managed aggregation is. And if I talk about the rent side, the companies mainly follow two kind of a strategy. One is managed spaces, where this company like EFC and Awfis allocate a whole space, a whole building to a specific one company. Okay, that is called managed space, where the company will book a seat of 200 300, okay, for a period of 3 year, 5 year, 6 year. So that is the managed space. And one another is co-working space, where people like freelancers, a small group of people, I mean 5 6 7, can book a room on a specific date for a specific time, and then they can go there, they can do meetings, they can do conferences. So that is what the co-working space is. And if I talk about the revenue from both of this, the managed spaces are more in, like, they are more consistent, obviously, because there is a lock-in period, there is an agreement between the between two companies. So the volatility of revenue is lesser in this model, the revenues are more recurring. So that is the managed spaces. And in terms of the co-working, the revenue is more volatile. Okay, sometime it will be high, it will be, and sometime it will be low. So that is the thing with co-working space. So that is the thing with the rent side. Okay, and if I talk about from a perspective of freelancer or a small company, obviously they can use those co-working spaces for their business. Okay, a freelancer is getting a very good environment in a very very small amount, with a very small amount. So that is the thing with the co-working space. And if I talk about the managed spaces, then it is for the big companies, where the company is taking 200 300 500 seats. So that is the thing with this business model. And if I talk about this industry can grow at a rate of 20-25%, and I think, if I am not wrong, it is growing at a rate of 20-25% now. So that is the thing with this industry. And one another thing what we have to keep in our mind is the revenue, rent to revenue in the tier 2 cities are greater than the tier 1 cities. Like in tier 2 cities, the rent to revenue goes up to 2.5x, where in the tier 1 cities the rent to revenue is around 2x. Like, what is rent to revenue? As I said earlier also, if a company is paying, if EFC and Awfis is paying a rent of 10 rupees for a building or a space, they are getting a revenue of 2 to 2.5x. Okay, so that is the thing of rent to revenue. So tier 2 cities are more, tier 2 cities have more margins in terms of the rent to revenue. So that is the thing. If I talk about the size of the companies, that how many centers all of these 4 companies have, then Awfis is at number 1 with 232 centers all over India. Then it comes Indiqube spaces. They have around 120 centers all over India. Then EFC has around 82 centers, and then the smallest is the Dev Accelerators, who has around 28 centers all over India. So that is the thing with the size of the companies. So Awfis is number 1, then comes Indiqube, then EFC, then Dev Accelerators. So that is the thing with the industry and the business model. So let's talk about the Q1 FY26 result and Concall of Awfis. Okay, so if I talk about this the company, they are mainly present in 2 segments. One is the flexible workspace, and one is the furniture. One is the fit out. Okay, fit out work. Like all of this company, most of them, as they have expertise in the interior work, in the furniture work, because the flexible workspace is all about building interior, building furnitures. So they have some kind of a experience, and they have some kind of a expertise at that front. So most of them tend to do those things for their clients also. So that is the thing. And if I talk about Awfis has 2 segments in their business. One is the flexible workspace, and one is the fit outs. It means that the interior work, mainly the interior work. So that is the thing. But if I talk about the revenue from the co-working space, the flexible workspace, then this segment contributes around 83% to their revenue. So the contribution is very high from this segment, and from the fit out it is around 17%. So that is the thing. And if I talk about their business model, 64% of their centers are in managed aggregation. That is why Awfis has a very asset-light business model. Okay, so that is the thing with the Awfis, and that is why if you look at their ROCE also, that is pretty high. Their ROCE is around 67%, which is very high if I see it. So that is the thing with Awfis. That is the business model. They mainly focus on the managed aggregation, in spite of doing the state lease model. Okay, so that is the thing with the Awfis. If I talk about their revenue, then in this quarter they grew their revenue by 30%. Okay, And if we look at their past performance also, they have been a company with a revenue growth of 30-40%. Okay, so in terms of the revenue growth, they are growing at a very good rate, and they have been growing. Okay, they have been growing at a very good rate of 30-40%. And if I talk about their guidance also, the guidance is around 30% growth in FY26. In FY25 also, they gave a guidance of 30% revenue growth for FY25, but they did better than 30%, so that is a very good thing. And in this quarter also, they are at 30% level. And if I talk about the roadmap for this kind of a growth, that how this 30% growth will come, then if I talk about the seat additions, they have around 1,60,000 seats in their company, and in this quarter they added few thousand, 21,000 seats in this quarter. And year on year, if we look at the seats, number of seats grew by 39% year on year. So they are growing their number of seats at a very good rate, and at a whole year FY26 they are planning to add around 40,000 seats in their company. So the growth rate becomes at 30% for the whole year FY26. So that is the seat additions. So what is the revenue guidance is 30%, and if we look at their seat additions, that is around 30%. Seat addition guidance is around 30%. So that is the thing. And if we look at the new signs in this quarter, Q1 FY26, they signed 15,000 seats. So it is a very good thing. And if we talk about the delivery of these seats, in total around 18,000 seats will be delivered, will be operationalized by Q2 and Q3 over Q2 and Q3. So that is a very good thing, that 18,000 seats will be operationalized over Q2 and Q3. So revenue from this 18,000 seats will come. And then obviously there are many old centers where they will improve their occupancy. If we look at their occupancy level also, then their occupancy rate improved by 200 bps year on year, which is very good. Their occupancy rate is around 73%. So there is ample space to improve that occupancy level towards 75-80%. So that is another thing they can get, and we can expect a gradual up move in the occupancy rate. Okay, so that is how they can grow their revenue at a rate of 30% or more than 30% also, because if we look at their guidance for seat additions, it is around 30%, and then there are little price hikes here and there, 3-4% price hikes are there, then the occupancy level can improve in the future. So that is the thing. And if we talk about their operational seats, then obviously over next 2 quarters there will be 18,000 seats, minimum of 18,000 seats will get operationalized. So that is the thing with the seat additions also. And then if we talk about the EBITDA margin, if we look at the pre-Ind AS EBITDA margin, because we should look at the pre-Ind AS EBITDA margin more than the the Ind AS EBITDA margin, because obviously it is a rent heavy business. The rental expenses are very high, and one of the main expenses in this business. So obviously we have to look at the pre-Ind AS EBITDA margin here, and I will explain it in a video, and I will provide the link of that video, that why and when we have to look at pre-Ind AS than the post-Ind AS. Okay, in certain business model, in certain industry, pre-Ind AS EBITDA margin, pre-Ind AS PAT margin makes more sense than the Ind AS EBITDA margin or PAT margin. So that is the thing, and I will explain it in a video, and I will provide that link in the description box. Okay, so that is why we have to, in this industry also, we have to look at the pre-Ind AS EBITDA margin more. So if I talk about the pre-Ind AS EBITDA margin, in this quarter they improved their pre-Ind AS EBITDA margin by 300 bps, which is very good. 300 bps by year on year. Okay, so which is very good. And if we look at their guidance also, they are guiding us for a 17% 17 to 18% of EBITDA margin going forward. Now they are at around 14.5% EBITDA pre-Ind AS EBITDA margin, and going forward they are expecting a improvement of another 300 bps. Okay, which is very good and which is very positive also. So in terms of the EBITDA margin, that can improve. Obviously, as I said, that the occupancy level can improve further because if we look at the occupancy rate, that is around 73%, which is, I think, the lowest in the industry. Okay, so they can obviously improve their occupancy rate further, and they are improving their occupancy rate if we look at their performance. Okay, so that is what can trigger the EBITDA margin improvement in the future. And there are few another things that will help their EBITDA margin to grow, like if we look at their services, office space, they provide few services to their clients, like mobility service, like food and beverages service. Okay, with the help of another company in that space of mobility, food and beverages. Okay, so that is the thing, and from there they can earn some commission. So that is how the income might grow further. Okay, the margin grow, the margin, EBITDA margin might grow further because of the fee income, commission income. So that is one thing. And another thing is that they are opening gold and elite centers. Like they are planning to open on 3 to 4 elite centers in this year. They have 3 elite centers, and they'll open another 3 to 4 centers. And obviously gold and elite center are premium centers. Okay, that is why margin in those centers should be higher. So obviously that is why these things can trigger a improvement in the EBITDA margin further in the future. Okay, so that is the thing. In terms of the, if we talk about so again, if we talk about the improvement of EBITDA margin, if we talk about the EBITDA margin, how EBITDA margin can improve, one is the occupancy rate, one is the allied services, one is the gold and elite centers. These three can play a big role in their business to improve their margin further. Okay, so that is the thing with the EBITDA margin. In terms of the PAT margin, if we look at their Ind AS PAT margin, then at a Ind AS level they grew their PAT by 250% in this quarter. Last year they did a PAT of 3 crore, and in this quarter they did a PAT of 10 crore. So that is why because the base was very low, that is why the growth rate is high in this quarter. But if we talk about the growth that has been there, so that is the thing. And if we talk about the PAT margin also, PAT margin improved by around 200 bps in this quarter, which is very good. Okay, so that is the thing with the result of Awfis. Overall a decent set of numbers. If we look at the growth rates of revenue, then the margins, occupancy, in all the parameters there are improvement. So that is the thing. Very good set of numbers, and they continue to improve their business model, their business. And one thing I like about Awfis is their ROC is very high. Okay, it is around 67%. So that is one another thing to look at. And obviously in the future they can grow at a similar level of 30-40% with the help of what? With the help of the seat additions, the occupancy rate. Okay, obviously there are many things for the margin improvement also. So overall a really good company that can easily grow at 30% and easily improve their margin. So that is the thing. But we have to track this company quarter after quarter. So that is what we have to keep in our mind. If I talk about the valuations, if we look at the index level PE, that is around 54%, 54x. But if we look at the pre-index level PE, that is around 30x, which is very low if we look at their growth. Obviously, as I said earlier also, in these businesses the pre-index numbers makes more sense than the post-index number. Okay, so if we look at the pre-index, obviously the PE is around 30x. So that is why the valuation of Awfis is not very high. I would say that if we compare to other companies also, that I will compare at the end, obviously. But yeah, obviously if you are getting a company at a rate of 30x at with a growth of 30% with levers of margin expansion, so obviously it is a good deal. I am not saying that you have to buy or not. You have to do your own research, that what you have to do. But in terms of the valuation, it is not 55x. Okay, be very sure about that. It is not about 55x valuation, it is about 30x valuation. If we look at their pre-index business, pre-index numbers. Okay, so that is the thing with Awfis. So that is the thing with the Awfis. Let's talk about the EFC Q1 FY26 result and Concall of EFC. Okay, so if I talk about their segments, they have three segments in their business. One is the rental segment, one is the interior, means that design and build segment, and one is the furniture segment. Okay, but if we look at their revenue by segment, their rental segment contributes around 60% to their whole revenue. Then D&B segment contributes around 40% to their revenue, and then the furniture segment contributes around 3% to their revenue. Okay, and if I talk about their revenue, their revenue in this quarter grew by 115%, which is very good. I mean, 115% revenue growth is like amazing. And if I talk about their past performance also, they have been growing at a rate of 50, 60, 70% consistently. So that is one very good thing with EFC. And if we look at their segmental revenue growth, then the rental segment grew by 83%, which is huge, absolutely huge. Then the interior segment grew by 140% in this quarter, year on year, and furniture division grew by 68% quarter on quarter. Okay, furniture segment grew by 68% quarter on quarter, not year on year. Okay, so that is the thing with the revenue. Okay, and if I talk about the guidance of the management, they are giving a guidance of 60% revenue growth in FY26, and that is the guidance they are giving. And if I talk about that, what are the levers, to achieve that 60% revenue growth in FY26? One is the seat additions. Like what the management is guiding us, they are guiding us for a 41% growth in seat numbers in FY26, which is very good. 41% is a very good number, I would say. That is the number one thing. And if we look at the Q1 also, they added around they added around 3006 quarter on quarter, and the number of seats grew by 35% year on year, which is in line with their guidance of 40% seat number growth. So that is the thing with the seats. So they are growing their number of seats at a very good pace of 40%. So that is the number one thing. Number two is the DNB business, where they are expecting a 60 to 70% growth in FY26, and in this quarter their DNB segment grew by 140%, which is like amazing. And the third is the furniture segment, where they are expecting a revenue of 150 crore, which is a very good number. They started their furniture segment few quarters back. Okay, so that is the thing with the revenue growth. So they are expecting a revenue growth of 60% in the year of FY26. So that is how the 60% growth will come. Okay, in terms of the, I explained that they will add around 40%. They will add around 40% seats in FY26. Then obviously DNB business will grow at a pace of 60-70%, and furniture division will make a revenue of 150 crore. So that is the thing. And if I talk about the EBITDA margin, in this quarter the EBITDA margin improved by 100 bps to 46.5%, which is a very good number. I don't have the pre-Ind AS number, it is a post-Ind AS number, but that is the thing. The EBITDA margin improved by 100 bps, which is very good. And what they are expecting, that the EBITDA margin will be higher going forward in the Q3 and Q4 because of the seasonality, because they are saying that in Q1 and Q2 are little low in terms of the margin, but Q3 and Q4 are higher in terms of the margin. Okay, so that is the thing with the EBITDA margin. And are there any levers to improve their EBITDA margin further? I think there is a very low chance to improve their EBITDA margin further, because if we look at their occupancy level also, that is around 90%, which is very high. I would say that is very good and very high. So in terms of that, I am little doubtful that their occupancy level will improve further. and that is why I don't see their EBITDA margin to improve from here further. Obviously 1 2 3 bps here and there can happen, obviously, but in terms of the improving by a good margin, it is little lesser. It has little lesser chance. Okay, and in terms of the PAT, in this quarter they grew their PAT by 200%, which is very good in terms of the PAT. In terms of the PAT margin also, that improved by 600 bps, which is very good. Overall a very good set of numbers. I think they can grow at a pace of 50-60% easily in the future. Obviously they are guiding us for a 60% revenue growth, but they are doing far better than that. So let's see what happens in the future. Overall a very good set of numbers. And if I talk about the valuations, the PE, the current PE is around 24x, and 24x for a company who is growing around 100% rate. Or the, if I talk about the guidance also, guidance are for 60% growth going forward. So in terms of the valuation, that looks little cheap, obviously, no doubt about that. So that is the thing with the EFC. You have to do own analysis that should you buy or not. But as a company, it is doing very good. The growth are there. They are sustaining their high growth. Like in the past few quarters also, they have been growing at a very high rate of 60-70%, and still the growth rate remains very high. Okay, so in terms of the EFC, it is a very good company growing at a very high rate, and the valuations look very reasonable, very cheap. So that is the thing with the EFC. So let's talk about the Indiqube Spaces, which is a new company. I mean, new company means it is new to the market. In this quarter, this company did their IPO. So that is the thing. So let's talk about the company. So Indiqube Spaces, if I talk about their segments, they don't have any DNB segment. Most of their revenues are coming from the segment of the flexible working space. Okay, and if I talk about their locations, their geography, they are Bengaluru heavy. Out of 120 centers, 68 centers are in Bengaluru. So that is the thing with the Indiqube Spaces. And one another thing I have to say is that they are now focusing very heavily on the tier 2 cities. Okay, so that is another thing with the Indiqube Spaces, but still it is very Bengaluru heavy. Like over 50% of their centers are in Bengaluru. So that is the thing with the Indiqube Space. If I talk about the revenue in this quarter, they grew their revenue by 28%, which is in line with the Awfis. Okay, and if I talk about their guidance also, they are guiding us for a 30% revenue growth. And one another thing which is very good with this company is that most of the revenues are recurring in nature. Like 98% revenues are recurring revenue, which is very good. And one another thing is that multi-center clients contributes around 35% to their revenue, which is very good, because if you have more and more multi-center clients in your business, obviously the trust of that company on your company becomes higher. So obviously this company, I mean these clients, can give you more businesses in different locations. So that is a very good thing, that 35% revenue are coming from the multi-center clients. So that is the thing with the revenue, and as I said, they are guiding us for a 30% revenue growth in in FY26 as Awfis also. So in terms of the guidance, that is pretty good. And how this guidance will come, how will this growth rate of 30% will come is that if we talk about their expansion plan, they are planning to expand their operating area by 35% in FY26. So that is how the expansion plan is, that they will increase their area, operating area by 35% in this year. And obviously if the operating area grow by 35%, obviously the revenue can easily grow at a rate of 30%. So that is the thing. And one another thing is the occupancy. If I talk about the occupancy rate, that is around 85%. So they have a very little space to improve that occupancy rate. Like they can improve it further to the 90%. So that is one thing. And one another thing is the rent to revenue. If I talk about the rent to revenue, that is around 2.26x, and it improved by a huge margin. I mean, in the last year Q1 it was at 2.02x, and in this quarter it improved by 0.4x to around 2.26x. Okay, so that is a very good thing, that in terms of the rent to revenue, it is improving, and we can expect further improvement because they are looking to expand in the tier 2 cities. And as I said, that in tier 2 cities the rent to revenue is higher than the tier 1 cities like Bengaluru. Okay, so there are further room to improve that rent to revenue, obviously. So that is the thing. And they are consistently improving their rent to revenue, so that is a very good thing in terms of the. And obviously if we look at their occupancy, that can improve further. In terms of the rent to revenue, that can improve further. So obviously in terms of the margin, EBITDA margin can improve further. In this quarter, if we look at their pre-Ind AS EBITDA margin, that is around 21%, improved from 13% in quarter 1 FY25, which is very good. I mean, improved by 800 bps, which is very good. I mean, if I talk about their Ind AS EBITDA margin also, that also improved by 150 bps in this quarter. But obviously the pre-Ind AS EBITDA margin makes more sense about their business. So that is the thing with the EBITDA margin. Okay, and obviously if they can improve their occupancy rate, if they improve their rent to revenue, obviously their EBITDA margin can improve further. Okay, so that is the thing. On another thing, the company is saying that with the help of what, economy of scale, that they are opening new centers in new places. So with the help of economies of scale, what they are getting now, they are getting a lower capex rate. Okay, like if I talk about it, like if 1 year earlier, if a capex of a building cost them around 1000 rupees, now they are getting that capex amount at 950 rupees. So they are getting that building, that capex at a lower cost. But what the management is saying that they don't want to bring down the capex number, the capex amount. But in spite of bringing down the capex number, what they are looking to do is provide more quality, to improve the quality. Okay, so that is what the thing company is looking to do, that they do not want to compromise on the quality, and by improving their quality, obviously the customer might satisfy a bit more. Okay, so that is what the company is looking to do. And if I talk about the management commentary also, that is, they are saying that they want to improve their quality in spite of doing a lower capex, in spite of lowering their capex. And obviously by doing a better quality, they can extract a little more margin from their business. So that is what the management is trying to say, that they want to improve their quality, then savings on the capex side. So that is the thing the management is saying. And in terms of the, if I talk about their PAT, if we look at their in-dash PAT, that is around that in in-dash basis, on the in-dash basis, they are PAT negative. But as I said, it is not the right way to judge a company who has a very high rental expenses. So obviously if we look at the pre-index PAT, then they are profitable, and obviously they are also paying the taxes. Okay, so that is one another thing, that they are paying taxes, so the company is profitable. So if I talk about the PAT, in this quarter they improved their PAT by 300%. Okay, so that is a very good kind of an improvement. Obviously the base is very small, like in the last year's Q1 they did a PAT of 6 crore, and in this quarter they did a PAT of 18.5 crore. So the PAT improved by 300%, which is very good. So that is the thing. And if I talk about the whole number of Indiqube in this quarter, overall a very decent set of numbers. They can easily grow their revenue by 30% going forward. And obviously if we look at their valuations also, if we look at the pre-index PE, then it looks a little high, and is around 75x. Whereas if we look at Awfis, that is around what, 30x only. So in terms of the valuation, it looks little high, but again, the whole industry has a very very long future in front of them. They can grow at a high pace for a long period of time going forward. So that is what I want to say about this company. But obviously the PE looks little high if we compare it to the growth, because they are expecting a 30% of growth, revenue growth going forward. Obviously if they get operating leverages, PAT might grow at a higher level of 30-40%, and they should get a operating leverage, because of the, as I said, that they can improve their quality in spite of by not increasing their capex. Okay, so that is what I am trying to say. So obviously that is the thing with the Indiqube, a very good company, but valuations looks a little high. So that is the thing with this company, but company looks all right. And the last is the Accelerators. you might know that it is going through the IPO. So yeah, that is the thing. So if I talk about the company, it is the smallest of all these four companies. As we know that it has only 24 centers, whereas other companies has around 100 to 100 centers. Okay, so it is very small company. If I talk about their strategy, they are mainly focused in the tier 2 cities, and they rarely have centers in the tier 1 cities. Okay, so that is the thing. Why they are focusing? Mainly because of the rent to revenue is higher in the tier 2 cities. That is why the management is more focused on the tier 2 city. So that is the thing. And if we talk about the business model, most of them are managed spaces. They I think they have around 1%, 2%, 1 to 2% revenue coming from the co-working segment. Okay, so the whole revenue is coming from the managed spaces. So that is the thing with the company business model. And in terms of the revenue, if we talk about the revenue growth, in FY25 they grew their revenue by 47%, which is really good and fair enough growth. In terms of the diversification of customers, their top 20 customers contributes around 54% to their revenue. So they are fairly diversified in terms of the customer concentration. And if I talk about the occupancy rate, their occupancy rate is around 87%, and which is very good and very high also. And if I talk about their improvement in terms of the occupancy rate, in FY24 their occupancy rate was around 83%. In FY23 their occupancy rate was around 81%. So they are consistently improving their occupancy rate quarter after year after year. So obviously the occupancy rate is little high, and they have very little space to improve their occupancy rate further, because 90%, 92% should be the ceiling. Okay, obviously, but obviously one thing we have to look at is they don't have the co-working space, so that occupancy rate can go up to 90-92% obviously. So that is the thing with the occupancy rate, but it has very little space to improve further. So that is the thing. In terms of the expansion, they are looking to add another 3,200 new seats over next few quarters. Till now they have around 14,000 seats, so the growth rate is fair. And if I talk about the IPO funds, also 50%, more than 50% IPO fund will go to the expansion work. Okay, so that is one another good thing. And one another thing, a unique thing, is that this company, Dev Accelerator, is looking to expand in Australia. Okay, why they are expanding into Australia? Because one of their clients are looking to expand their business in Australia, so that is why they want to enter that market of Australia. So that is the thing. But obviously we have to look at what are their near-term plans are after the IPO proceedings. Okay, and so that is the thing with the expansion. And if I talk about the valuations, post IPO market cap would be around 550 crore. Okay, and which translates around 3.5x market cap to sales. Okay, which is, if I compare it to other companies, which is fairly good. If we look at Awfis, its market cap to sales is around 3.2x. For EFC it is around 4.1x, for Indiqube it is around 4.3x, and for Dev accelerators it is around 3.5x, which is fairly good. Okay, so that is a thing with the Dev accelerators. So that is the business model of Dev accelerators. They are mainly focusing on the tier 2 cities. So that is one another good thing they are doing. So let's see what happens in the future, how they can keep growing at a higher level of 40-50% and keep beating Awfis and Indiqube. Okay, so let's see what happens in the future. So that's it for the Dev accelerators. So if I talk about the whole industry, if I talk about it, the whole industry can grow at a very high pace of 20-25%. All of the company in the industry is very small. As I said, that the biggest player in this industry has a market cap of 4,000 crore, which is a small cap company. So the biggest player has a market cap of only 4,000 crore. So this space has ample room to expand further, okay, in all over India. So that is one thing, and all of these 4 companies are growing at a very decent pace of minimum 30%. Okay, that is one another good thing in this space, that all the companies are growing at a very good rate. And if I compare the growth rate of all the companies, EFC has been the number 1 in terms of the growth. But if I talk about Awfis is more consistent in terms of the growth. Then Indiqube also growing at a very good pace of 30%. Awfis also growing at a very good pace of 30%. And now Dev accelerators, they can easily grow at a 40-50% higher than Awfis and Indiqube, because they have a small base. Okay, so that is why if I look at all the companies in this segment, all the companies are growing at a very good and decent pace if I look at their results. And as I said, there are ample room to expand, ample room to improve their parameters. Okay, so that is the thing with this industry. All of the companies in this industry are good. So let's see what happens in the next quarter. So that's it for the video. Thanks for watching.